Good afternoon and welcome to the final session in our Empower CF Conference 2021. And it's also one of our professional advisor webinars. We're going to give everybody a chance just to get into the room before we get started here. So just bear with us a couple minutes and we'll start in just about 30 seconds. Okay, well, once again, welcome. My name is Steve Jewell. I'm with Community Giving, and this is the last session of about 3.5 days worth of sessions for Empower CF 2021 conference that we've been sponsoring at Community Giving. Really here just to help and support community foundations and a place for all of us to learn. And certainly we've had some wonderful sessions, and I think we've all learned a few new things, as well as have a number of ideas to carry forward as each of our organizations work to make a difference in the communities we serve. Today, we're very pleased and excited to have Shale Lapping with us. Shale obtained his undergraduate degree from the University of Illinois, where he graduated Phi Beta Kappa, his MBA from McGill University in Montreal, Canada, and his law degree from the University of Chicago. Shale is a chartered financial analyst, designation awarded by the CFA Institute. He is a member of the CFA Society of Chicago. Prior to the investment field, Shale practiced corporate law for 6 years, specializing in a broad range of legal and investment issues that impact various types of trust funds. Shale began working directly with the investment community in 1989, when he joined the firm that served as the predecessor to the IPEX. Shale was vice president of that firm for 7 years and has been president of IPEX since the firm's inception. And we've had the pleasure of working with Shale over the years, and we're pleased to have him today present on the topic, Investing for Foundations and 2021 Investment Outlook. So I'm going to turn it over to Shale. The executive director of the Wilmer Community Foundation, Sarah Carlson, is going to be helping out with questions throughout. So we'll turn it to Shale and along with Sarah. Shale?
Thank you much, Steve. Great to be here. Great to have the opportunity to talk with everybody. Ideally, next year we can do this in person, kind of with some more feedback and tailor things to exactly the topics you're interested in. But I think we have a very good topic today. I'm looking at slide 4 with the topic of today's presentation, Investing for Foundations and the 2021 Investment Outlook. And those are really two distinct topics. And if you move to the next slide, slide 5, my overall take here is that I intend to minimize the 2021 investment outlook. And one reason for that is I tend to be fairly skeptical of forecasts or outlooks in general anyway. You always have talking heads giving you lots of information there, but what that's worth at the end of the day is somewhat questionable. But even more so is because our focus is on investing for foundations. And that's who we're talking to today, our foundations, primarily community foundations. And our perspective very much, and I'll go now to slide 6, is foundations have a long-term time horizon. Theoretically, you have a perpetual time horizon. And because of that, we're not particularly concerned about what is transpiring or going to transpire over the next 6 or 12 months. And our view very strongly, and something we do preach on a regular basis to all of our foundation clients, is that they should have primarily a strategic approach. And you can use the word strategic as somewhat synonymous with long-term, as opposed to a dominant tactical or short-term approach. It doesn't mean you ignore what's going on in the short term. You certainly don't want to do that, but you want to make sure your eye is really on your long-term goals. The critical issue is not how your foundation performs or is structured for the next 6, 12, 18 months, but really to make sure you're structured properly to generate the level of returns that will help you meet your goals over the next 10, 15, or 20 years. And it's very easy to get distracted from that. There's all sorts of distractions out there in the media that we're confronted with every day, and that's how they make their money. But we want to be sure we keep our eyes on what is really important to us. So I would stress that long-term strategic approach, as we move through this presentation and as you continue to deal with your foundations, on a regular basis. As we move to, slide 7, the key point here is whether you have a short-term focus or more of a long-term focus, particularly a short-term focus, it's dangerous to think that you can outsmart the markets, whether you're focusing on either the short-term, or the long-term side. And part of that is simply reality. It's hard to do. The vast majority of professional investors are not successful in doing that. You always hear of the ones that do, but they tend to be fairly few and far between. And the governance structure of most community foundations makes that somewhat difficult. And by that, I mean meeting with a committee on a quarterly basis and thinking you're going to make decisions that are going to enable you to outsmart the markets and do better than the broad indices over those short periods of time is not typically a great recipe. It's not all or nothing approach. If you have interest in a different type of tactical adjustments, often that can be achieved by incorporating investment vehicles into your investment program that have shown some expertise in making tactical decisions. And they have the wherewithal and the ability to make those decisions on a day-to-day basis on their own within the structure of their particular investment fund or investment portfolio. And they're not coming back to your committee for approval. But again, I would stress those tactical components typically should be a relatively small portion of your portfolio, and the dominant portion should be, for the long term. Not at all to minimize the importance of your investment committee, but as we tell our clients, on a regular basis, the reality being none of us are that smart at the end of the day. And the more decisions that we make, the more difficult it is to achieve our goals, the more likely it is that we're going to, underachieve. And there's absolutely nothing wrong in holding pat for a while and not necessarily making a lot of changes in a portfolio. And if we go to the next slide, I think we all recognize that 2020 was a crazy year for the market. And we're not going to spend a lot of time debriefing everything that happened, but no one really could have anticipated what took place over the course of the year. And I mean that in terms of what happened late in the first quarter, when the markets were responding to the outbreak of the virus and everything shutting down, and we saw really unprecedented levels of volatility and negative returns on the equity side, and we saw fixed income rates drop to virtually nothing. And then before we even realized what was happening, the markets rebounded. Very strong returns for equities, not just toward the end of the first quarter and the second quarter, but really throughout the course of the year. And we saw that level of volatility, and we saw those types of strong returns, both on the equity and fixed income side. And one of many takeaways that I would mention there is none of us realistically recognized that we could have made the proper calls anticipating what would have taken place in 2020. And I go the next step then, what makes us think we're smart enough to make those calls for 2021? And the reality is that very often we are not. Most foundations, however, despite the crazy environment that we were in for 2020, ended up doing very well over the course of the full year. And the reason they ended up doing extremely well is, for the most part, they didn't do anything. If they stood pat, they would have done very well. You notice at the bottom of this slide 8 here, I have the word unless. The foundations that didn't do well, the ones that got hurt, were the ones that made major timing calls. They pulled out of the market at some point, in March when things were collapsing, or they pulled out somewhat later in the course of the recovery, feeling that valuations were too high, and they missed a lot of the recovery. And fortunately, most foundations, I'd say, did not do that, but it underscores how critical those timing calls can be. If you get the timing call right, you're a genius. If not, you're kind of a bum. And it's very difficult because you have to make 2 good timing calls, not just one. You have to decide the appropriate time to get out of the market and the appropriate time to get back in the market. Those are very difficult calls to make. And no one's saying that difficult market conditions are going to recover as fast as they did last year. The level of the recovery was almost unprecedented, but markets do tend to recover over time. And for a long-term investor, making those types of timing calls is a fairly difficult thing to do. So again, standing pat is very often a good way to approach the environment. Let's talk a little bit about what has taken place in the environment, though, because the environment is not static, by any measure. What we saw for most of 2020 and for a good portion of the last few years has been a market dominated by so-called growth stocks. in particular for 2020, it was a handful of stocks that dominated the major averages for the vast majority of the year, really up until Labor Day or so. Then you began to see a little more breadth in the market overall. And toward the fourth quarter and toward early this year, you saw a shift from growth to value. Now, I've made a conscious decision to try to minimize the number of numbers I'm going to present in this presentation because I want to keep things more conceptually. But in a few areas here, I think it's important to present some numbers simply to underscore the significance of what we're talking about. If you look at the broad market and you break it down between growth and value, however that's defined, but there are core indices, and there are growth indices, and there are value indices. For the full year for 2020, if we look at the Russell 3000, which essentially replicates the entire domestic equity market, the growth component of that Russell 3000 was up by a little over 38%. By comparison, the value component was up by a little less than 3%. That is a tremendous differential. And that even takes into account the fact that at the very end of the year, the last 6 weeks or so, value recovered and did better. But you see the differential for 2020. What happened in the first quarter of 2021? A little bit of a change. When I say that sarcastically, the value component for the first quarter was up almost 12%, and the growth component was up a little over 1%. Those are seismic shifts in the marketplace, and they're very, very difficult types of shifts to call on that. If you get them right, you're a hero. You get them wrong, you're a bum. It's not a high percentage game to play overall, but it shows you how you can be whipsawed in terms of what's happening in the marketplace. The other thing to recognize now is valuations are pretty high in the marketplace. By valuations, I'm talking about price earnings ratios, basically how expensive the domestic equity market is. Not quite as expensive it was back in the tech bubble in 1999 or so, but fairly expensive by historical standards. And that was the basis some people used to pull out of the market last year. But again, trying to make those timing calls is a very, very difficult thing to do. And in terms of historical perspective, I would note, many of you will recall back in 1997, the famous remark by Fed Chairman Alan Greenspan, when he talked about irrational exuberance in the markets. And his concern there was the PE ratios were very, very high. It was a bubble environment was going to collapse. And he expressed his concern very specifically there with that term. Well, Greenspan was right, but he was 3 years early. The market continued to go up. It didn't correct until 2000. So the point here is just because valuations are high doesn't mean they can't go higher. You don't know. It's a very difficult call to make on that. And right now we're in an environment with high valuations. We're also in an environment with a tremendous amount of money in the environment as a result of both fiscal and monetary stimulus. We have an economy that is continuing to reopen, not quite back to where it was, but moving in the right direction. Very strong forecasts for strong GDP growth over the course of the year. How much of that will be reflected in the marketplace? You just don't know. But again, trying to make those timing calls based upon the current positioning is a difficult thing to do. I've been talking so far primarily about the equity markets. We can also talk about the fixed income markets somewhat. Fixed income rates have been very, very low as a result of the way the market responded to the pandemic early last year, and as a result of Fed policy keeping rates extremely short on the short end of the spectrum. Fed fund rate ranges between 0 and 0.25%. You can't get much lower than that and still be positive. The Fed sets rates at the short end of the spectrum. The market sets rates for the longer end of the spectrum. Let's talk about the 10-year Treasury. Over the course of the first quarter, the 10-year Treasury, due to market forces, increased significantly. It essentially doubled. It went from about 80 basis points to 1.6%. So that's a huge percentage increase. It's still very low by historical standards. And everyone is concerned that rates are going to continue to go up significantly. Well, they may, you don't know. But since the end of the first quarter, that 10-year Treasury rate has effectively stabilized right around that 1.6%. So will it go much higher? It may, but it hasn't so far. Trying to make those calls is a very, very difficult thing to do by any historical measure. One quote I like from a fairly famous investor is that trying to predict stock prices over the short term is foolishness. Trying to predict interest rates over the short term is idiocy. And I would tend to subscribe to that. And the reason we have to be aware of these things is now we are in an environment where we are confronted with 24-hour financial news channels. Obviously, the news available to us through the internet. And there are talking heads giving us their prognostications and their analyses of the market environment on really a real-time, constant basis. We're bombarded with that information. And to some extent, it's good. But by the same token, we have to recognize that all these media sources are compelled to put information out to us. And as of yet, nobody has really perfected that crystal ball. Just because people are talking doesn't mean they really have a high probability of being able to tell us either accurately why something happened or what is going to happen going forward here. And again, I want to underscore that applies to both the equity sides and the fixed income sides. We have to take all this information with somewhat of a grain of salt, or maybe a boulder of salt, all things considered. All those comments are pretty much by way of introduction. In the presentation we have today, I'm going to focus on a number of distinct topics, and I'm moving ahead now to slide 10 on the topics to be addressed. I've listed 8 slides or 8 different topics I'm going to address. And most of these topics really would warrant a full presentation in and of itself. So my comments are going to be really more by nature of overview than anything else. But I am going to try and weave into many of these topics commentary regarding the current environment as far as what we experienced in 2020, and also as far as what we're likely to experience in 2021. So again, I'm not detaching my comments from the market environment, but I would rather deal with them within the context of specific topics here. I've also tried to make all these topics fairly distinct, on a standalone basis. And one of the advantages to that is we can deal with them on a bite-sized basis, but I really want to try and pause and encourage questions at the end of each one of these topics. So please don't be bashful here. I'd like to make the time together we have here today as much interactive as we can, rather than just me, providing information to you over this time. So please don't be bashful. Put your comments into the chat. And again, I'm going to try to pause and give you an opportunity to raise them and to address them as we move through each one of these different sections. I am now going to move to slide 11. And again, the first distinct topic we're talking about is investment process. And I would sincerely hope here that I'm not presenting anything that is new to anyone. If you listen to any presentations pretty much over the last 20 or 30 years, you've probably had this type of process drilled into your head by anyone who's talking about things from a financial perspective. And that process is important. So nothing really new. I don't plan on walking through it in an awful lot of detail. Even in this section, I'm going to focus primarily on, the first subpoint here, establishing objectives, and how it relates to the second on the asset allocation. I do note under the last comment here, monitor, I've added the words do not fixate. And I'd say that's fairly important. Monitoring an investment program and being aware of what's going on as far as the broad investment environment is certainly important. The typical practice is for a committee to meet quarterly and to review the reports and review the environment, and that's all good. The point I want to underscore here, though, is just because you're reviewing your program doesn't mean you need to make changes. All of your investment vehicles in the program will not be performing well at the same time, and some may appear to be a bit problematic. You want to note that, you want to be aware of that, but you want to avoid the temptation to make frequent changes in your program. And that applies to both the asset allocation and the mix of the individual investment vehicles here. There's absolutely nothing wrong with going a year or two in an investment program and standing pat and not making changes. Again, there may certainly be opportunities to do so, but don't feel compelled to make those changes on a regular basis. More often than not, those will not be the right calls to make. Let's move to slide 12. Again, we're fairly early in the presentation here, but the point that I would stress is I would consider this slide to be the most important one we're going to talk about today, and really the takeaway. We're talking about targeted return and expected return. And this relates to our topic of setting investment objectives. And the concepts of targeted return and expected return are often used somewhat interchangeably. I would stress they are very distinct concepts, and it's important that we understand them and that we understand the relationship. Targeted return, which I've abbreviated as TR, we'll use the next few slides, represents what you want to achieve. It's based upon your objectives. It's your goal. It's something that is aspirational. However, it doesn't mean it's something you pull out of thin air. We're going to talk specifically in the next slide as to how you go about setting your targeted return for your investment program. On the other side is your expected return. That is what your particular investment program is likely to achieve. And that's based upon your particular portfolio. These are two distinct concepts. And as you see, ideally, we're saying they should be the same. And again, they're concepts here. They're never going to be exactly the same mathematically, but they should generally be in sync. If they're not in sync, then you have issues here you probably want to confront and make some adjustments somewhere, in the course of your investment program. But what I want to do now is drill down into these two and see exactly what we're referring to in the context of particular community foundations. Let's go to the next slide. And again, we're talking now about TR, the targeted return for your portfolio. What I've listed here are 5 distinct components of that targeted return, most of which you're going to be familiar with. The first one is your spending policy. That's the policy that determines the money that leaves your foundation and goes, to people who are the recipients of your money. Fairly straightforward here. Exactly the nature of those recipients will vary somewhat from the individual component funds, but conceptually we're in agreement. This is really the purpose of your foundation, is to get money out the door to the various types of entities, not-for-profits, that are going to make use of that to fulfill the mission of the foundation and your individual donors. Number 2 are your investment expenses. All of the expenses associated with the operation of your investment program. Money managers, mutual funds, exchange-traded funds, custodians, consultants, whatever those may be. All of the expenses here. And I would note some of those expenses are more transparent than others. In the case, say, of a custody fee or a local manager, you are probably paying a direct fee that you can see debited from your account. In the case of a mutual fund or an exchange-traded fund, that fee is embedded within the investment vehicle. You're never seeing a distinct debit here, but that fee is as real as anything else. So when you're calculating your investment expenses, you want to make sure that you are including all of the expenses associated with the investment of your investment program. The third are administrative expenses. Again, that's pretty straightforward. That's the money that comes out of your investment program and goes to your foundation so that you can operate. Fourth is a little bit different. It's something that we refer to as an inflation allowance. And I would stress here, we are not trying to predict inflation. That's about as hard to do as trying to predict stock prices or interest rates. We're not going to try and make a call and say, we think inflation is going to be X% over the next 12 or 24 months. What we're doing is we're building inflation, though, into our targeted return model. We're saying that we are making a certain allowance for inflation within our targeted return. Ideally, the inflation rate will not surpass that, but if it does, we recognize that we will have an erosion of purchasing power. But we're not ignoring inflation, we are making some allowance for that. As we get to the specific figures here, that'll become a little bit clearer. The last component, real return, is what I'll refer to as the holy grail of an investment program. That means ideally that we have structured a total return that meets all 4 of the components and also allows for a real rate of return, so that not only will we be preserving the purchasing power of our portfolio, but we will be enhancing it. All 5 of those components, after a thoughtful process, should lead you to a total return number. And while all 5 of those are important, I would draw a line and distinguish between the first 3, the spending policy, the investment expenses, the administrative expenses on the one hand, and the inflation allowance, the real return on the other. And the difference is the first 3 are real cash flow expenses. Again, let's not worry about the fact that your mutual fund fees or ETF fees are paid within the investment vehicles, but those are actual costs that your investment program is experiencing, and they detract from your real return. The other two, the inflation allowance and the real return, are more conceptual in nature. They certainly impact your return and the financial status of your program over time, but you're not seeing those monies withdrawn or debited from your investment program on a real basis. So all five of these factors are there, but they're a little bit different. I would also point out one similarity among the spending policy, the investment expenses, and the administrative expenses. While those are all very different types of expenses, obviously the purposes are very different. From the standpoint of analyzing an investment program, and from the standpoint of seeing whether you're going to have sufficient coverage to offset inflation or to generate a real return, those first three, a spending policy, investment expenses, and administrative expenses, are exactly the same. What do I mean by that? I mean, a dollar coming out of your investment program, whether it's used to fund grant making, whether it's used to pay an investment advisor, or whether it's used to fund your internal foundation operations, is a dollar that is not left in the investment program and is unable to offset inflation and is unable to generate a real return. So again, it's kind of important to understand these differences here. I've spoken about these somewhat in the abstract. Let's go to the next slide, slide 14, and look at some of the real numbers here. Again, these are numbers I pulled out for illustrative purposes. They're not tied to any particular foundation, but I think they're probably pretty good ballpark numbers overall. I've used 4% as a spending policy. Many foundations have numbers that might be a little bit higher, a little bit lower. If you were a private foundation, you would have a requirement for that spending policy to be 5%. But here we're looking at a 4% number. In the case of investment expenses, I've used half a point or 50 basis points. Your expenses could be a little bit higher, a little bit lower, but that's probably a pretty good ballpark figure. Administrative expenses for your foundation, 1%. Again, most foundations will probably be at that level or somewhat higher. So far for our actual cash flow expenses, the real cost, we're at 5.5%. I've used 2% for inflation allowance. Again, kind of a ballpark figure here, lower than the long-term historical average for inflation, which we'll discuss momentarily, and lower than a lot of the projections that we'll see for, over the next, year or two. But I think a reasonable figure. And I have used 0% for real return. Again, I consider that to be somewhat of the holy grail. It's great if we can realize that. But with this example here, you can see that even allowing for a 0 real return, our targeted return is 7.5%. And that might not seem to be that high a figure when we're experiencing a year like 2020 overall, or the first quarter of 2021, when the equity markets are generating really strong returns overall. But my point here is trying to budget over the long term here. That 7.5% target can get a little bit challenging. And let's go to the next slide. Again, if we remember our original formula, if our targeted return is 7.5%, that means that we need an expected return of 7.5% to be in sync. And we know we're not going to generate that 7.5% return every year. That's not the way the markets work. We want to have some reasonable level of confidence that we can generate that level of return on average over time with some reasonable probability. And I would say here, over 50%. And I'm being a little bit at the low end, but that's kind of what we're shooting for. So let's go to the next slide and talk about how do we arrive at an expected return. It's a modeling process. And here's where your asset allocation really comes into play. That second phase of the process. We set the investment objectives and we try to set a target asset allocation that will generate an expected return theoretically in line with the targeted return. And again, it's a modeling process. You look at the various components of your target asset allocation broken down within fixed income, domestic equity, international equity alternative, and you start running some fancy Monte Carlo simulations. And those give us some probabilities of generating expected returns. And the point we always stress to our clients, those simulations are a very good basis for discussions, but again, they're not a crystal ball. It's a model we're using here. And another line I will often mention is all models are wrong, some models are useful. Doesn't matter whether they're trying to model the path of the coronavirus last year, we saw the impact of models there, or we're trying to model investment results. It's a starting point here for discussion, but it's the best that we have for our overall purposes here. And I want to give you a few real world numbers here now to put things in perspective. Models are always based upon the assumptions you use, and we can discuss what the appropriate models are all day. But I would mention a recent model that we did on an asset allocation study for clients. And I would say this was a reasonably aggressive portfolio. Not super aggressive, but probably toward the aggressive side in one of the scenarios we modeled. And our target allocation here was 20% fixed income, and only 12 of that was core fixed income. So it was still a fairly aggressive fixed income portfolio. 65% of the portfolio was in equities, both domestic and international, and 15% was an alternative, a mix of strategies here, some more aggressive than others. When we did the modeling for that portfolio, again, which I would say is somewhat for the aggressive side, the expected return we came up with based upon the Monte Carlo modeling was about 7.3%. Not bad, all things considered. And again, we're not trying to generate a particular result. We're trying as hard as we can to be realistic here, but less than that 7.5. And the probability of generating even a 7% return over a 30-year time period, and when you run these models, the longer time periods tend to be better than the shorter time periods, that probability was 57%. And the way the modeling works is getting a return of a probability of over 65% tends to be fairly unlikely unless you're very, very low, which is why I mentioned getting a probability over 50% is probably acceptable. But here, let's pull a few of these loose ends together. We use some fairly conservative numbers, I would think, building up to our targeted return. We ended up with a targeted return of 7.5%. And we demonstrated here that generating that 7.5%, even with a reasonably aggressive portfolio, is very, very far from a slam dunk. And it's something we want to keep in a perspective as far as the importance of keeping our eye on the long term and how difficult it is to generate these returns. What I've given you so far, simply a couple examples that are somewhat theoretical and based upon the modeling process that we generate, internally. But I also want to bring to your attention some, real world numbers here. And hold up an article, maybe you can see this for a second or so on your screen there. And I'm referencing an article that I saw in the Pension and Investment magazine, kind of the Bible of the investment industry, from very late 2019, relatively recent. But the title in the article were fairly important. And the title was fairly short and was as follows: Public pension funds abandoned 8% dreams. And plans throughout the country, primarily very, very large plans, very often multi-billion-dollar plans that have the best investment advisors imaginable, that have access to basically all of the investment vehicles out there. And the conclusion they have come to is trying to generate those returns of even 8%, historically they were higher, was very This is the end of 2019. In 2010, by contrast, 59 plans had assumed rates of return of 8%, and another had rates higher than 8%. The average of all the plans in the survey now was 7.25%. And I would also note that the incentive for these plans, being public sector plans, is to have pretty high rates of return. Because if they lower their rates of return, they are forced from an actuarial standpoint to go back to their funding sources, the state and local governments, and ask them for more money. And that's not something they typically want to do. They want to try to avoid that at all costs. By lowering their rates of return, that's what they're putting themselves in a position to do. But what that does is underscore how they view the investment environment and how challenging it is to experience or generate 8% returns or 7.5% returns. And I'm pretty confident that in the year and a half or so since the end of 2019, those rates of return, those targeted rates have stayed the same or come down. Nobody is getting more aggressive, in this environment. So it is a challenging situation out there that we need to be aware of, when we are working with our distinct portfolios. That is really wrapping up the investment process section. So before we move to the next section, please, I want to encourage questions or comments if anyone has them. Please feel free.
Shale, we do have a question that was privately chatted to me.
Great.
And I also want to let you know that we're having some buffering that's coming on your presentation, Shale, so we may need you to loop back around occasionally on something.
Okay.
But the question is, what are your thoughts on community foundations lowering their spending policy from 5% to maybe 4 or 3% to better withstand likely volatility in the market? And is this the most controllable item in a community foundation's approach?
That's a very good question. I would say it is the most controllable item. Ideally, that's something you want to do. But the real key question is, what can you afford to do from a market standpoint? And I think, as we all know, community foundations' biggest competitors out there are, the major gift funds, at a Schwab, a Fidelity, a Vanguard. Their expense structures tend to be lower in many respects, and they are offering, because of that, the opportunities for a higher distribution rate. So the question becomes, if you were to lower your rate, 0.5% or 1% on that, what is the reaction going to be from your current donors? And what impact is that going to have on your prospective donors in that, when you tell them that's what you're going to be generating? So theoretically, I think it's great if you can keep your eye on the long term and you can lower your spending rate in order to bring your targeted return down to a more manageable level in sync with your expected return. But there very well be market forces out there that make it much more difficult for you to do so.
Thank you, Shale. Then the next question, I think, is something you're intending to tee up in the next section. So I'll just introduce the question. And if you'd like to proceed to the next section, that would be fine. And that is, how does the anticipated trend towards inflation and higher interest rates impact or affect foundation investment strategies?
Good tee up. I will be covering that momentarily here as we move forward.
All right.
Couldn't plan that question any better. So I am going to move to slide 17. We're going to talk about inflation. And inflation is clearly the bane of long-term investors. Some of us are concerned now, all of a sudden we're going to see a much higher inflation rate, but even a moderate inflation rate over time, and that's what I'm talking about long-term investors, you start compounding even a low rate of inflation over 10, 15, 20 years, it is a disastrous impact upon a long-term portfolio. And in some cases, that's more clear-cut than others. And we've had the discussion about inflation with many of our community foundation clients, and some are more concerned about it than others. They recognize the importance theoretically, but some will say, well, most of our donors are primarily concerned about getting money out the door today. They know the causes. They're not really concerned about 20 or 30 years from now. On the other hand, they will say, many of our donors, are deceased. So we're obviously taking into consideration their wishes, but there's no one there who is really going to raise a major concern about the fact that the principal, is eroding in their portfolios. And I think those are legitimate points. And every community foundation has to make the decision on its own as to how important, inflation is. What we do is we encourage them to have the discussion with their individual donors, and make sure those donors understand what the impact of inflation will be on their particular portfolios, over the long term, depending upon their spending rates. And I think there's one example here, brings that to mind a little bit more clearly. A fairly, common, purpose for many, funds at community foundations is to fund scholarships. And we know a couple things. We know historically that the rate of inflation for higher education, there's a specific higher education inflation index, has been significantly higher than the broad market inflation index. So, let's talk about one example. Let's say that you have a particular fund that gives a scholarship of $5,000 each year. And currently, or when it was set up, that $5,000 scholarship, might cover, say, 50% of the costs of a local financial institution. It's a pretty good percentage. But if we look down the line with the rate of inflation, either on a broad basis or specifically higher education, it may turn out that 10 years from now, the cost of that education may have doubled, very possibly. So if the underlying funds to support that scholarship have not doubled, the value of that scholarship erodes. The scholarship that may have covered 50% of the costs initially, 10 years from now will cover 25% of the costs, and it will further erode over time. So the dollars are still there, but what that foundation or what that scholarship was designed to accomplish becomes less and less over the future. And that's simply one example. And again, that's why we encourage clients to consider inflation, but how you build it into the program is very difficult. And if we go back to that formula we looked at a few years ago, everything is trade-offs. More money set aside to offset inflation is less money that's spent today, or less money that goes to the foundation for administrative purposes, or trying to cut the cost further down for investment expenses. And it is challenging. And again, at 7.5% target we ended up is very, very far from a slam dunk. Many foundations are using targets now of 7% and informally looking at 6.5%. It's hard to get to those numbers. So, it's a balancing act here, but it's something we encourage, everyone to look at. Let's go to the next slide. One term you may have heard bandied about in the news very recently, it's transitory inflation. And that was mentioned specifically by, Fed Chairman Powell, pretty recently talking about the environment. And what he is referring to, and what the Fed's posture is that they expect inflation to, increase a good deal over the course of 2021. And that's a result of the economy reopening, lots of pent-up demand out there. Consumers will be out there spending money, fueled in part by all of the savings they've accumulated over the course of the pandemic and the closures, and fueled in addition by all the stimulus money that's out there. They think that money will fuel inflation over the course of the year. We have certainly already seen that as far as commodity prices over the last several months, but they feel the impact of that inflation will be, as they refer to, transitory or temporary, but that will subside into as we go into 2022. And we saw that very clearly last month when the inflation rate for April, and that's the year over year figure, April inflation for 2021 compared to inflation for April 2020 was at 4.2%. And a big increase there isn't unusual. Again, in April 2020, the economy was effectively shut down, and it's reemerged now in this quarter. But that inflation rate was higher than expectations. The expectation was for a rate for April about 3.6%, and we ended up at 4.2%. So that is concerning the markets somewhat right now. Whether or not the Fed will be right and the higher inflation we're experiencing is transitory, or whether or not it's going to be more longer term, it really remains to be seen. We don't have an answer to that. I mean, I wrote a lot of articles. You have extremely well-reasoned positions on both sides of the coin. That's just simply another unknown right now. But from an investor standpoint, there are two distinct questions. Going to the next slide now, slide 9. What will the inflation rate be? And that's an economic issue. And the second question is, what do you do about it? It's an investment issue. Both fairly challenging. Inflation has been pretty low now for quite some time. I won't go through all the numbers here, but we had annualized inflation of well over 7% for the entire decade of the 1970s. And each decade since then, the rate of inflation has come down somewhat. Inflation was about 2.5% in the first decade of this millennium. And the Fed was targeting to get inflation up to 2% for most of the last decade, and they fell a little bit short of that. So the Fed has actually been trying to encourage a 2% target inflation rate, and they've been unsuccessful. And maybe that'll happen now going forward here. There are a few gloom and doomers right now that are expecting, super high inflation rates, but some rates of inflation a little bit higher than what we've experienced over the last few years is certainly a possibility. But remember, we are now inundated with all sorts of talking heads and pundits on the news channels, and they have to have something to talk about. And inflation, to a large degree, is the topic du jour. So it's something we want to be aware of, but we want to be careful about pushing the panic button on that. But the question becomes, what do you do about that? And if we go to the next slide now, slide.
Shale, we are experiencing a lot of latency right now, so we may need you to actually use a landline phone
With
to
all
call in and double up.
investment. Pardon?
I said we are
Okay.
experiencing a lot of latency, so a lot of buffering,
Okay.
and we missed that entire section there. So we may need you to pause and actually use a landline phone to double up on the audio here.
Okay. Where should I go back to? What number do you want me to call in?
We will chat that to you, but go ahead and keep presenting as best you can, and we'll try and get that covered, okay?
Okay, sure. My point here on slide 20 is that there is no magic bullet. There's always trade-offs. We want to keep our focus on the long term. You'll often have people talk about gold or real estate or real assets. Our feeling is that there can be an appropriate allocation to real assets, which is arguably beneficial, doesn't have a perfect correlation to inflation. But here we're talking about a broad basket of commodities. We're talking about underlying real assets. We're talking about real estate in different forms on that. They tend to do fairly well as far as holding their value in an inflationary environment, but they're not something you want to load up on very, with a super high portion of a portfolio. And if you go to slide 21, and I kind of tie this comment back to the earlier comments relating to a target allocation for a portfolio or a strategic allocation for a portfolio. You want to make sure your allocation to equities is sufficiently high and diversified. Equities, a broad basket of equities, large cap stocks, small cap stocks, domestic, international, tends to hold up fairly well in most inflationary environments. Fixed income is more challenged. Most foundations, community foundation portfolios, don't have a very high allocation of fixed income. So your current allocation is probably pretty good. You want to make sure your fixed income component is sufficiently diversified here. But if you have that good target allocation, you're probably fairly well structured to begin with. And if we move on to slide 2, the takeaway here is you don't want to overreact to short-term inflation concerns, which may or may not be accurate. What you do want to do is build in that inflation component into your expectations for your long-term return target. Again, remember that formula. And again, in the example we used a 2% inflation allowance. It's very easy to, quote, cheat, unquote, in that formula when you're ending up with a targeted return that's too high, because you need to keep your spending at a certain level and you need to keep your administrative costs at a certain level, and you want to make sure your targeted return is not too high. The tendency is to bring that inflation allowance down. Instead of 2.5, it's 2. Instead of 2, it's 1.5. That's the real concern. The concern is not coming up with some specialized investment that will combat inflation. Your concern is making sure there's an overall sufficient allowance for inflation in your portfolio so that you're leaving enough dollars within the portfolio to combat inflation, in the broader investment environment. Questions or comments regarding inflation before we move on to the next section?
There are no questions in the chat or in the Q&A on this section. And since we only have 13 minutes left, we'll just keep moving.
We'll keep moving along. Next topic here, as I indicate, is somewhat of a boring topic, but it's an important topic. And this is cash management. And this is something that we have addressed with a number of our clients over the course of the last year. It's something we typically address with them, but because of the level of volatility in the marketplace and the concerns about what was happening both on the equity and fixed income fronts, we've addressed cash management, even more so. Again, boring, but important. And let's go to slide 24. And I want to define what cash management is. From our perspective, it's tying something into your spending needs. By that I mean working with the money you expect that you will need to expend over some defined time period, next 6, 12, 18 months, something along that lines. But it's money that you will be spending. What cash management is not is market timing. It's not pulling money out of your investment program and putting it into a cash component with the idea of putting that money back into the market sometime later on. That is an entirely different game and something we strongly discourage. So we're focusing on your spending needs here. If we go to the next slide, slide 25, I would talk about, what are the key trade-offs here? And again, there's always trade-offs on the investment side. You're talking about an opportunity cost versus peace of mind. Money that is held in cash under any environment is going to generate a nominal return. In the environment that we are in and have been in for most of the last year or so, that nominal return is effectively zero. But as we tell our clients, it may be a zero, but it's a positive zero. It's money that's secure. You're eliminating the concern about incurring a loss there. You're taking safety, and you're accepting that opportunity cost for the peace of mind of knowing that the dollars are there and you can withdraw those dollars without worrying about incurring a loss. And the real issue becomes, what is your typical cash flow for your foundation? And what's important here is getting back to the basics, having good financial controls, good forecasts, good budgeting, having a pretty good handle what your expenditures will be over the next 6 or 12 months and budgeting for them, and knowing historically what your cash flows are as far as contributions, donations, and as far as expenditures. Donations, we know, can be tricky because a lot of your money tends to come in the form of bequests, which are unknowns. By the same token, you tend to know historically whether or not your foundation has been cash flow positive or cash flow negative over most periods of time. And that's the starting point for determining how much money you need to be holding as far as reserves. If we go to the next slide, slide 26, we discuss some of the different ways for holding cash in your investment program or for your foundation overall. And there's basically two options. One way is to hold cash within the investment program itself. And typically that's done, for starters, as part of your target asset allocation. You're going to have targets for domestic equity, fixed income, international equity, and alternatives, but you may also have a target allocation for cash. For example, that might be 2.5%. So if you're concerned about cash in the environment, you want to make sure that you are at your 2.5% target or maybe slightly above. You may make a conscious decision to overweight your cash at 3.5%. So that what money is added to your investment program, instead of investing that money as you typically would, you're going to leave that money within the cash component. The other alternative is not to have a cash component within your investment program, or not to be worried about overweighting that target, but they have money outside of the program. For example, you may have a policy that you always want to have 6 or 12 months of your expected cash flow needs sitting in an operational account, your checking account, a typical bank account you can readily draw upon. So again, two options here. One, keeping the money within the investment program, one, keeping it outside of the investment program. Couple points to understand here. Either way, you are incurring an opportunity cost. That is money that is earning a nominal or non-existent return, as opposed to the return that you would expect to generate through the investment program. But again, you're doing that for the peace of mind, for the security. From the standpoint of the foundation overall, again, taking a broad perspective here, looking at your overall financial situation, which includes the investment program and the operating accounts, whether you're holding cash within the program or outside of the program makes absolutely no difference. The key is just making sure you have an appropriate level of cash to give you the necessary peace of mind based upon your budgeting. Next slide, slide 28. However, while it makes no difference overall as far as the total foundation, there are some differences that you should be aware of. If you're holding cash within your investment program, and that cash is generating a nominal or non-existent return, that is impacting your portfolio return. If the market's going up, that's a negative. If the markets are going down, that cash will be a positive, but it impacts your total return and may very well impact your peer group rankings compared to other foundations that don't have that cash allocation. And here I'm drawing a distinction. You can take two foundations that both are the same size, and both are maintaining the exact same level of cash. But one is maintaining that cash within the investment program, and the other is maintaining the cash outside of the investment program. The end result is going to be the actual returns for those programs are going to be different, and their peer group breaks are going to be different, even though they're holding the exact same level of cash. And even within your own program, if you're holding cash above your target allocation, say you have a 2.5% target and you're holding 5% cash, that's going to impact your own internal benchmark variance. If the market's doing well, you will most likely lag your benchmark because of the nominal return for cash. If the market's doing poorly, that cash is going to be beneficial. So there are impacts here that you need to be aware of. And I'm not sitting here saying which approach is right, which approach is wrong. They're both legitimate here, but you need to be aware of the impact that holding cash will have on the performance numbers you're generating and how it will impact your comparisons to other foundations. Questions or comments on the cash component before we move to the next section, which will probably be the last section I will work through fairly carefully.
There are no questions in the chat or in the Q&A relative to this section, Shale, so please proceed.
Okay, I will do so. And I'm going to work my way through the rebalancing section here and wrap up. And I guess we'll have a good start for our presentation for next year, and hopefully with some more questions as well. But rebalancing is also a very important topic in all environments, but in particular, it's been an important environment over the last year, given the level of volatility that's taken place in the broad market. And I want to begin, again, defining, like I did for cash flow, what rebalancing should be and what it should not be. Ideally and practically, rebalancing should be a disciplined approach. And there's different types of approaches. We'll talk about it. It should be disciplined. What it should not be, again, is market timing. Simply a cavalier approach to reposition the portfolio based upon your assessment of the current market environment and the way that market is likely to respond over the next 3, 6, 9, 12 months, whatever. That's not a good way to approach rebalancing. But let's move to the next slide now, slide 30. There are various approaches for rebalancing. They can be time-based, so you can rebalance every month, every quarter, every year. That can be tied into a variance, that you have ranges around your portfolio and you will only rebalance when you're outside of a range, or you may rebalance automatically whenever you hit a particular time period. We have one client, for example, that rebalances yearly regardless of what the variances are. And your policy might be to rebalance all the way back to a particular target if you're out of compliance, or it may be to rebalance halfway back to the target. And there are all sorts of combinations of these different rebalancing policies. Overall, though, the particular policy you employ is not that critical. The studies that we have looked at over time say the specific approach doesn't make that big a difference if you apply it consistently and are disciplined. Again, the concern is changing rebalancing policies or really disregarding the rebalancing policies and engaging in a form of market timing. So typically we'd say do something that is simple to calculate and administratively simple to implement. And if you do that consistently over time, you're probably going to be pretty good. Let's go to the next slide, slide 31. Again, when we talk about target asset allocation, what we're typically focusing on are the targets. What can be just as important there are the ranges, the minimums and the maximums. If we have a target for 35% domestic equity, is our maximum 40 or is it 45? And the same on the downside there. And again, our take is you want to have appropriate ranges, not too broad, not too narrow. You want to give the portfolio some opportunity to participate in what's taking place in the broad market. But again, you set a strategic allocation for your portfolio based upon your objectives and based upon your risk profile. And if the portfolio starts to differentiate too far from those targets, you don't have what you said you wanted to have. You're incurring too much risk or too little risk. And the purpose of those targets is to make sure you kind of stay within the bounds you established and don't get caught away in the frenzy of a certain market environment. And I would also note you want to set those targets, at least we would suggest, not just for the broad asset classes, but also for the individual investment vehicles. You might not be overweighted in domestic equity overall, but one of your particular domestic equities may have done phenomenally well and now represents a disproportionate percentage of your portfolio. So rebalancing with respect to that vehicle is important, even though the overall allocation for domestic equities might be in sync. Let's go to the next slide, slide 32. And I would differentiate here between official rebalancing and de facto rebalancing. And this is something that is particularly important for community foundations based upon our experience, because you usually have a good deal of cash flows, both money coming into your program and money coming out of your program. Official rebalancing is what I'm referring to here as intra-portfolio changes. If you are overweighted in domestic equity and you are underweighted in fixed income, what you do when you rebalance is you sell some of your domestic equity positions or portions of them, and you reinvest those proceeds in fixed income. That is what I refer to as official rebalancing. De facto rebalancing is different. Your community foundation now all of a sudden has a large contribution. And if at the current time your portfolio is underweighted to fixed income, that contribution will be used to purchase fixed income and bring you closer to your fixed income target. Conversely, if you need to take a withdrawal from your portfolio now and you are overweight in domestic equity, you would use that withdrawal as an opportunity to sell some of your domestic equity and move you closer to your target. Now, I would stress, you're not being tactical here. You're not trying to time which segment of the market is going to do better, but you are using the cash flows, the contributions, distributions as an opportunity to move your portfolio closer to your targets. And with many of our community foundations, the cash flows are sufficient that we rarely ever face the issue of having to do official rebalancing. We're able to keep the portfolio sufficiently in line with its targets based upon de facto rebalancing. And the final slide in this section, the final slide I'll mention in this presentation here, a little bit tongue-in-cheek, is rebalancing is not something that's optional. At some point, if you do not make a conscious decision to rebalance, either through the official rebalancing or through the de facto rebalancing, the market will rebalance for you. And that can be swift and that can be severe, and it's something that you want to try and avoid. So again, cash flow, rebalancing, not the sexiest topics around, but very important topics, something we've spent a good deal of time addressing with our clients over the last year or so based upon the market environment, and particularly important because these are issues directly within the client's control. You're not going to control how the various segments of the market perform, but you can control to a real degree how your portfolio is impacted by that based upon how you control your positioning and your cash flow with a disciplined approach. So any final questions now regarding this section or any other aspect of this presentation? We have made it roughly halfway through. And I think as a result now, we're going to have a good basis for other topics we can cover at next year's presentation. But I thank you for your time here. Sorry if we had any audio difficulties. But again, if there's any additional questions you have or you have as a follow-up, please feel free to submit them to Sarah. I'd be happy to address them and get back to you individually. Thank you for your time.
Thank you, Shale. I'm going to turn it over to my colleague, Carl, for some closing comments.
Thank you, Sarah, and thank you, Shale, very much. Now I understand what my treasurer, Tim Bergen's talking about when he said it was a complex issue that took a while to learn. So thank you. That was very interesting. Thank you all for joining us today. We appreciate it. If you want any assistance with your clients and charitable giving goals, contact any one of the 4 executive directors in your area that you saw on the screen. We want you to know that we have resources available for professional advisors. At first, website plangiving.communitygiving.org is a great site for professional advisors working with clients on plan giving goals. So we encourage you to use that. We have additional resources at the link right below that, the PRAD resources. If you want to look back at any of our professional advisor webinars, and any other of the topics that we've been holding regarding COVID or race relations or anything else, you can find those at our communitygiving.org/community connections. We probably have about 40 of those now to choose from. Some of our foundations still have COVID-19 response funds available, and grants to be made in those areas. You can find that at the COVID-19 site. And finally, we encourage you to share your thoughts with us today by mailing info@communitygiving.org. Our next professional advisor webinar in the series is on June 24th. It's on qualified plans and testamentary planned gifts. So once again, this wraps up our Empower CF 2021 conference. We want to thank all of our conference sponsors and attendees for joining us, and those of you who just joined for this session today. So thank you very much. Goodbye.